Good morning, everyone. Welcome to the InfoVest Podcast. My name is Daniel. Today is December 16, 2020. And today we're just going to quickly go over the markets. And so we saw yesterday quite of a rally in the S&P 500, the Dow, NASDAQ, and Russell. Russell being the leader of all the indices. Mainly on the back of this spending bill, this stimulus bill that is expected to come. In the overnight session today, we also did see a rally during the European session and up to leading to today, where all equity indices as we speak are at the highs of the session. We have the S&P at around 3,700. Which tends to be kind of a key level where we touch a psychological level of 3,700 area. So it'll be interesting to monitor this and see if we are going to bounce around this level, or will we get a chance to break out of this level. What could cause this to break out is for any level of optimism that comes into the markets, especially regarding the stimulus bill, and we can see huge kind of relief rally in equities, especially in the Russell, as the Russell is 1970 and close to that $2,000 mark. We're very close. We're not far away, and so it's important to just monitor that and watch that, and the Russell is the one that will take full advantage of that news if it were to come out this week. So again, top congressional leaders are said to come closer this week, reaching to an agreement on the coronavirus relief package. Pelosi and McConnell did meet multiple times yesterday, and they plan on meeting today as well. So hopefully, today is Wednesday. Hopefully they can get something done by the end of Friday, which could happen as they have set some sort of deadline for their government stop bill kind of their package on getting some sort of government aid, government spending out into the markets or into the economy by Friday. So they kind of already have that deadline by Friday. So hopefully they can get something out this week. So that's kind of fueling the optimism in equities. And as far as bonds are concerned, we did see kind of yields kind of move up higher, especially on the longer end, and prices move lower, more on the longer end, and kind of the short end doing somewhat similar, but not as much as a movement than compared to the 30-year Treasury bond and the 10-year and so on. And we do see also that the euro, the pound, has been rallying overnight, and we do see gold has been on a nice rally as the dollar depreciates, and oil is around 47.64. Not much of a movement in the overnight session for oil. We did have API show basically a build in inventories, and so we did see kind of a leg down, and then that leg down being bought up very quickly. As expected, there are strong buyers in the oil markets, and so today we'll have to watch the kind of DOE numbers for oil. So for DOE, we have crude at expected of negative 1.937. And for gasoline, we have about positive 1.614 expected. So if we get a number for, let's say, crude in between the negative 1.93 to positive 1.97, we can expect crude to possibly have a dip that will be short-lived, and we can expect that the dip buyers coming in and bringing back crude higher. If we get a number greater than 1.973, we could see a sell-off in crude. Again, as we've seen it over and over again, just be wary of those dip buyers that come in that are supporting crude prices. And if we get a number less than negative 1.937, then we can see a strong rally in crude, pushing up higher against its resistance level at 47.90. Same thing goes for gasoline. Strong dip buyers there as well, where if you get a number between 0.828 and 1.614, you can probably see initial knee-jerk down, which could be bought up by traders. And any number greater than 1.614 would have a little bit of a stronger sell-off, followed by, I would say, watch out for a dip buyer later in the day. And number less than 0.8 can for sure see a rally in gasoline. So those numbers kind of to watch out. We did have, like I said, a lot of negative news in the past and pumping from Libya and so on with crude oil, but over and over again, as we see, crude is being very well sustained, especially with all this vaccine news and everything. They all tend to be pretty well sustained. So that's one thing to watch out when it comes to crude and gasoline. And the biggest eye-opener is that every time it dips, we do see strong buying coming back into the markets. In terms of Brexit news, we have the pound continuing its rally. We have MPs have been primed to vote for a possible Brexit trade deal, at the beginning of next week as hopes rise of breakthrough in Brussels. Senior government sources have confirmed that Boris Johnson is preparing to push back the Christmas recess should he secure an agreement with the EU by the weekend. So there are some rumors going on that a possible deal could come either by this weekend, hopefully by next week, as they keep pushing it. And the pound is liking that, and there's quite optimism in the pound as it signals that a potential Brexit deal is near. Hopefully we'll get that. Like I said in my yesterday's podcast, the Brexit and the stimulus bill will be quite important to watch out for this week. Two important factors, as well as the FOMC, which is meeting today. So a couple of things to keep in mind when you're trading this market is those big macro themes coming up, especially when you have Christmas coming next week and you have kind of lower liquidity and slower trading during this holiday season. Again, like I mentioned, dollar hovers near 2-year lows as stimulus continues to be the talks. Gold has been rallying as the dollar plummets, and oil prices they continue to rally, and OPEC Plus continues to talk about how demand outlook continues to weaken. Asian stocks climb on vaccine news and U.S. stimulus optimism as well. And we also continue to see a rally in European stocks overnight. And we do have FOMC meeting today. So this will be another big event. I mentioned quite a few things yesterday in yesterday's podcast about the Fed. If you want to hear more, please tune in to that podcast. So basically, to summarize, the key thing to look for is we know interest rates will be expected to be where it is at the target rate of 0 to 0.25%. We don't expect anything to change. We don't see it increasing or decreasing. We just expect it to be where it is, so unchanged really. While we also want to hear more about the quantitative easing program to run at least at its current pace, so that's the expectation. However, there's a growing consensus that analysts say that the Fed could tweak the weighted average maturity of its current debt portfolio. So meaning that they could change the duration of their bond buying to more of the longer end to suppress the yields, as we talked about in the last podcast, so that there isn't this effect in the long term of long-term yields rising and that affecting the mortgage rates and other long-term rates in the future, as traders could price in future rate hikes long-term. So we could, that's expected, and if we do get that, the markets will like that. If we don't, and if we get kind of a hawkish tone and we don't hear anything about this weighted average maturity, we don't hear about this kind of yields being suppressed on the long end, the markets will not like that, and that will kind of set a kind of a hawkish tone, especially in bonds. You'll see a rally in bonds. Sorry, not a rally in bonds, but a dip in bonds and the yields to increase. And you can see kind of stocks kind of fall on that as well. Any more dovish tone, we also want to hear kind of if the Fed is going to do more in terms of quantitative easing. Are they going to be ready to support the economy if things worsen next year? Are they going to be pumping more? They are already pumping money into the system, but the markets want to hear going forward, what's the forward guidance? What would be expected next year from the Fed in terms of providing some sort of more stimulus into the economy? So if there's any talks of more money being added into the system, you could expect that the stock market will like it very much, and that will set kind of a dovish tone, and you could see yields falling and bond prices moving up higher. So that's kind of the what to look forward for when it comes to the FOMC meeting today. In terms of the Fed economic projections, remember that is also coming out today in today's report. The board is also set up to update this economic forecast today. So most analysts expect that the committee to leave projections widely intact, especially as the near-term situation remains uncertain, even though medium-term prospects look healthier with the onset of COVID-19 immunizations. Analysts, the outlook that they see for the U.S. economy is to set numbers in September. So GDP growth was forecast to contract by 3.7% this year before rebounding to 4% in 2021. Inflation was also seen changed in the new set of forecasts, with median projections for total and core inflation at 1.2% and 1.5% respectively. The Fed said most participants expect inflation to rise over the next 3 years, although half of them anticipate PCE price inflation to still fall short of the committee's long-term 2% inflation objective by the end of the forecast horizon. The unemployment rate in the final quarter of the year was projected to range between 6.5% and 8%, with the median of 7.6%. So any projection change in the Fed's outlook in more of a positive tone can show that if these numbers improve, then the Fed will be signaling that, okay, economy is expected to do better, and for that reason, we could slow down the easing quite sooner than we expect. So the Fed projection is something to look out for. And if there's any downward revision, that will signal kind of a dovish tone, which means that the Fed will be there to help out in any way possible. And last but not least, BOFA's U.S. economist said that we expect the introduction of the language around asset purchases will seek to affirm existing market expectations and not suggest any earlier than expected reduction of monetary policy accommodation unless justified by improved macro fundamentals. So again, we expect the expected, which is what I mentioned before about this asset purchasing and this change in duration and the projections and the rates all being what is being expected. And the rhetoric might come out from the Fed saying that, we will stay tentative, we will continue to support the market. If things start to improve from the macro fundamentals, then they can start to possibly tighten. But they won't use these exact words. They won't use the word tighten. I don't think so. It's very unlikely. But they will use more accommodative language to say that the Fed is there to support whenever it is needed, and will continue to support until the virus and the economy starts to improve. So that's something to look forward for, especially in the expected guidance, where you can see what to look forward for in the next coming years. Other than that, in terms of economic data, we do have core retail sales today at 8:30 a.m. for U.S. So something to watch out, especially for many of your retail stocks, such as Walmart and even Amazon and Shopify. It will signal some sort of consumer sentiment that they are coming in and they're purchasing goods. A positive note would be great for these stocks. And then we have 8:30 a.m. Canadian core CPI coming out, and then we have manufacturing PMI also coming out for the U.S. and crude inventory at 10:30 a.m. as well. So few economic data that is coming out. We also heard in other news about Tilray and the pre-market. They're up kind of 31%. Share price yesterday was $7.87, and now it's at $10.27. So Tilray in talks of a merger with Afria. So that is a marijuana play, a cannabis play, and we're seeing kind of a move up higher in Tilray because of this merger news. Okay, so other than that, hope you enjoyed the podcast. If you want to hear more about the FOMC, please tune in to our yesterday's podcast, and hope to see you on the next podcast. Thanks. Bye.